Andrew, if you want to get going, please
Yeah,
do.
great. I will do so. And yeah, we've already got 2-3 very good questions in already. So I thought in the past, when we've done these things, we've tended to do a little bit of a presentation about why we're here and what we do. We thought that you've probably all seen that often enough by now. And so the idea of this little session is to essentially answer any questions any of our members have on the markets and why things have been doing what they've been doing, or not, as the case may be. And so I wanted to just quickly show a couple of slides, just to highlight a few things that have been going on in the market over the course of the last, initially at least, long term, and then just the last year. So the first one, which should come up any moment, that's a good start, isn't it? Right, try again. This is the performance of three different investments that we make over the course of the last 10 years. And these are generally known as income assets. They're the ones that are supposed to be ticking away in the background of your portfolio, providing long-term steady returns, not too volatile, not long periods where they give you negative returns. And I just thought this was worth noting that, as I say, this is 10 years, and that fairly long straight line is what you would have got if you've been investing in the bank for that whole period as a wholesale investor, so bank bills. And you'll see that the green line, which is New Zealand bonds, has actually given you exactly the same return for the last 10 years as investing in a virtually risk-free bank bill, which is extremely disappointing. But you can see global bonds, the orange line, have performed very slightly better over 10 years. But really, when you look at the scale on the left-hand side, they haven't provided much of a return. 20-something% over 10 years is really not particularly good when you annualize that. And what you can also see from that chart is that incredible return that was being provided by bonds up until not long after the pandemic. And that was the point when interest rates got to basically zero. And central banks were using all sorts of unconventional means to try and make sure that the whole world didn't fall into a hole. But of course, what we now know is that they didn't need to. We're a bit more resilient than that. And so the money and the interest rates that pumped into the global economy at the time caused inflation, and therefore caused yields on bonds to have to rise very sharply. And that's what's caused that very steep decline over the course of 2021, 22, even running into 23. And we're only just beginning to recover from that now. By contrast, if you look at the next chart, this is what shares have done. So the red line is unhedged. So that's just if you just hold all the share markets in the world in their local currency, and then convert back to New Zealand dollars. The green line is New Zealand shares, if you just invested in the New Zealand index for the last 10 years. And the sort of orangey line is if you hedged your position in global shares. Now, as you can see, for a start, the returns even from New Zealand shares are still very positive over the whole course of this period that you've done your money by 2.5 times. You can also see the New Zealand market has been rather flat for the last basically 4 years. But that, as I say, when you actually look at the scale again, on the left-hand side there, if I'd put the bond and cash charts on here too, they would be below that bottom grid line. They really haven't provided much of a return at all over this period. Shares have massively dominated. And so then I was just interested in the long term. In the very short term, this is just what's happened this year. So from 31st March last year to now, and it's a little bit it is a little bit messy. The straight line right in the middle is that bank bills. So that's what you would have earned taking basically no risk at all. And the two lines that have done very well are once again unhedged global shares and hedged global shares that have provided a very good return over the course of the last year. Disappointingly, the New Zealand shares are actually down very slightly, just barely up over that same period. And at least this year, bonds have provided at least a small positive return, even if not as good as bank bills. And I guess one thing I was looking to show from this is, firstly, generally over the long term, shares do extremely well, but also how difficult it is to pick. If we go back to the, can I go back? If I go back to the previous one here, you can see the volatility, and particularly around that 2021, 2022 period where things did go down. Obviously, when COVID hit, we had a sharp sell-off. But over time, as we've said many times, the market, the share market does tend to go up. That was pretty much all I had. Just as I say, just wanted to give a little background, little bit of background on what's been going on in the recent past. The bond market has steadied. There is a general feeling in the world that interest rates have probably stopped going up for now, and that the next move is down. The overriding, what would you say, mood, I suppose, is that at this stage it looks as though they're going to stay where they are for a bit longer than we would have normally expected. You would have liked to have thought that the central banks would begin easing rates by now, but inflation seems to be stubbornly still there in the system. So most central banks are holding off and not making any moves at this stage. Now, Jen, there were a couple of good questions I saw before I started that little chat. Do you want to start feeding those through?
Yes, sure. Sorry, kia ora everybody. Sorry about the technical difficulties in the background. So the first question that we have is from Robin. Andrew, can you give some details around the performance of the new high growth fund for the KiwiSaver scheme?
Yeah, of course. And thanks to that last chart that I showed you with the unhedged and hedged global shares rising as much as they have, the performance from the high growth funds has been extremely good. It's up around, it's about 18.5% for the 11 months that they've been in existence. We've got one more month to go before they hit their 1-year anniversary. And even in the short term, the last couple of months have been very good. They've returned well over 8% for the last 3 months. So, I mean, you're always nervous launching something like the high growth fund, which doesn't have any bonds at any time, because who ever knows what share markets are going to do. But we're pleased to say that since we launched those at the beginning of May last year, global equity markets in particular have done extremely well. So they've done very much what they're supposed to. That's not to say we're not going to. It's bound to have periods where they don't perform so well. That's just the nature of share markets. But for now, we're thrilled with how well they've done.
Thank you, Robin. If that doesn't quite answer your question, then feel free to drop another one in the Q&A with something a bit more specific for Andrew. So the next question is from M. Oh, what's that from? That's from a movie? It'll come to me. Not all of your investments are recommended by Mindful Money. Why is that? I want to invest ethically. Yes,
and we all do. Yeah, I'm not 100% sure why some of them are and some of them aren't. We have quite a lot of dialogue with Mindful Money, and we're a big supporter of what they've done. Where we find we don't necessarily feel we get full credit for what we do is they know that we screen out all of the things that we say we screen, fossil fuels, weapons, pornography, alcohol, all those things that are not in our funds. But the difficulty for us is that we're a passive investor. We like to keep our fundamental reason for being is to make you all as much money as we possibly can. And we think by keeping our fees down, that's the best way we can make everybody else wealthier. So therefore we're passive, which is a simpler way of doing things, which just means there are things that we don't invest in. If you do a lot of research and you're very active and you want to, you can find entities who only invest in, if you like, the good stuff. So we just don't invest in any of the bad stuff as far as we can possibly do. There are entities out there who will only invest in the good stuff. The problem with that is you end up with much more concentrated portfolios. You don't have anything like the diversity that you do in our portfolios. But some people feel that that's what they need to do. So from mindful money's point of view, I think sometimes we don't necessarily screen out something that they feel we should. From our point of view, the more important thing is as important is our motivation in all this, and the whole point of using what fees we do charge to contribute to charities and to try and assist people, we feel is as ethical as we can possibly be. So I assure you, everybody here is aiming to invest as ethically as possible.
I think that's good. I mean, basically, ethical investing, there's no technical one definition of that, right? So everyone is interpreting ethical investing in slightly different ways. We're very clear in terms of the information we share, how we have interpreted that and what it means for us. And we follow that policy that we have in place across all our investments. So
there's I mean, ethical is an extremely interesting word to try and define. What we've tended to do more recently, and most people have, is move away to things like responsible investing or sustainable investing, which are a lot more specific about exactly what you're trying to do.
So I hope that answers your question, Em. We do have a page on our website that goes into more detail and has a link to our responsible investment policy. So I encourage you to go and have a look at that. The next question's a little on the lighter side. Tell us about the aeroplane on the shelf behind you. This would be an easier question if it was Sam, because can you answer that, Andrew?
Okay. I would say that's an amphibious plane. It definitely looks like it lands on the water. It's the TEAL. I wasn't here in those days. That doesn't exist anymore, but I think that's an early Air New Zealand firm company. Yes, good question. As we say, we'll get Sam
online. Yeah, when Sam's on next, and he'll definitely be able to give you the long version of that. The next question is from an anonymous attendee. Are there any plans for an annuity type of fund? Thanks.
Yeah, these are good questions. I mean, the short answer is no. We did have something which was like an annuity. It didn't get much traction, and unfortunately, the insurance structure around it in the end didn't work when interest rates got down to such ridiculously low levels as they did in the early 2019s, 20s. What we are doing and what we have got is the ability to for you to make regular withdrawals without on a predetermined rate, but you have to work out how much you need. And yeah, we do. So I mean, the short answer is no. We don't have a genuine annuity, but we have the ability to take regular amounts of money out of your savings.
Am I right in saying that Sorted have a calculator that you can use, a retirement calculator, where you can look at how much you'll have at 65 and how long that will last in terms of drawdown and continued growth? I think there's a calculator on Sorted that can help.
There is, and there's also one that goes with everybody's annual statement now, as part of that annual statement. I mean, and they're not perfect. It always depends on exactly what you assume you're going to earn on your investment over the long term, which is where if it's a more structured annuity, that's a better outcome. But those, just in the New Zealand market, we've realised they don't work particularly well.
And speaking of annual statements, they're coming out next month, aren't they, for all Simplicity members in May?
Is it next month? Yeah.
Cool. Another question from Robin. Do you have any timelines on the implementation of splitting your KiwiSaver across different funds? Thoughts on splitting them with regards to fees? So that's another question. I think I heard Sam mention this at some point.
Right. Yes, I'm sure he did. Again, it's not something we're looking to do right at the moment. I mean, you do have to remember that every single one of our funds invests in exactly the same underlying investments. And so if, for example, you held our balance fund and our growth fund, all you'd end up doing is having a sort of mishmash that would stick you somewhere between balance and growth. So you're not increasing your diversification, you're just changing slightly your overall risk profile. So I've got mixed ideas. I mean, one of the reasons that, again, going back to why we're here, was that by restricting everybody to a single fund, it kept our underlying costs down. It keeps the registry costs down. So when we thought that through, the difference between charging more but giving some people the choice of investing, like I say, between products that were fundamentally the same underlying investments, rather than keeping the fees down for everybody, we decided to go for the one fund option. I guess if there's enough general demand to have something split people's investments, just keep the feedback coming. We'll always respond if, as I say, there's enough demand to do so.
Would another option be to have your KiwiSaver in one fund and then maybe have an investment fund that was in one of the different funds, if you had the ability to do that?
Yeah, I mean, there's no problem splitting your investment funds. You can have an investment in any one of those. It's just KiwiSaver that's restricted.
Okay, so sorry, Robin, no immediate plans, but obviously that's something that does come up, and that we will, keep an eye on that in terms of demand from our members.
Yeah.
Okay, the next question is a fairly long one from John. So I will read it out, and then if I need to read specific parts of the question again, I will do that. So hi, Andrew. What is your current outlook for equity markets and the path of inflation in New Zealand? 4 out of the last 5 quarters have seen negative GDP growth. And while goods inflation has come into better balance, service and commodity inflation are still stagnated. Also, Treasury spreads and yield inversions are still showing further weakness. With many equities overvalued, shouldn't you wait for better opportunities to DCA? I don't even know what that means. DCA, as it takes longer to recover. For instance, if your stock drops 50%, it needs to return 80%. And if it falls 80%, it now needs 400% to break even. I'm not sure if I guess that, so the main question is your current outlook for equity markets and the path of inflation in New Zealand, given that information that John then shared.
Yeah, sure. And that's, as you say, extremely detailed. Thank you, John. So without wishing to bore everybody, with the caveat that we can't give anybody advice personally, and none of this is advice, it's to a degree, my opinion. I mean, I fundamentally share your view, John, that there are parts of the equity market that are probably a bit overvalued. However, we take the view that the only way to avoid getting caught up in particularly one or two quite high tech stocks that are probably getting a little bit frothy, is to just diversify as much as possible. So in New Zealand, where we don't have that big tech sector, actually the performance, as I said earlier, from the New Zealand share market this year hasn't been particularly good. And who knows whether the industries that our very small stock market concentrate on will do any better. There's a lot of things like retail and gentailers, but in the States, which has really driven a lot of the recent returns from shares, I'm sure you're aware, there's really a very concentrated number of stocks that have driven most of that growth. So if those are seen to be being a bit overbought, it doesn't necessarily mean the whole market will start deteriorating. And that, as I say, means from our point of view, if we've got a little bit of everything, we're hopefully covering ourselves for if some of those higher cap stocks do get sold off. So that's a very long-winded way of answering. I'm sorry. But fundamentally, we think the best answer is always to stay invested. That's our underlying ethos. So we try not to pick markets. We just take what they give us.
Okay, thank you. I hope that answers your question, John.
Probably not.
The next two are from Marie. And oh no, just the one. And the question is, why is the growth fund been so bad in the last month?
Last month.
Yes, that is the question.
Okay, yeah. That's a bit specific. I'm just trying to think this month to date. Yeah, I mean, again, the growth funds mostly thrown around by share markets. They haven't had the best week or two. I mean, up until the end of March, they were doing extremely well. The main reason that that stocks have taken a little bit of a pause over the last few weeks has been what I was alluding to earlier, that there are still signs of inflation being more stubborn than we'd hoped, and therefore central banks are not now saying they're going to reduce rates as quickly as they were going to. It's a slightly strange one, because the fact that the economies are being more resilient, which you'd think therefore would be good for shares, we seem to be at a point where some days everything's bad news and some days everything's good news, which tends to mean that we are at something of a pivot. It may mean that we have a few more uncomfortable months from the market, but that it'll pick up again once it settles down. Just trying to think if there's anything specific I could pick on that would lead to that. One very important thing, it's a very immediate thing, is that those big stocks that I was just talking about, most of them announced their results this week. So it's likely to be quite a volatile week in the US share market in particular.
Okay, but we shouldn't be too worried about 1 month performance in any fund.
Well, no, and as I say, I'd only prepared myself with the returns up to the end of last month, and they were all looking very good. So it's been a much more uncomfortable month, but in a period that generally share markets have done quite well.
So another question from M. It's James Bond, isn't it? M. That's what I was thinking of before. Thank you. So I understand that even your index funds avoid the bad stuff. You don't necessarily look for the good stuff. So this is just going back to that ethical investing. I guess that's a fair summary, isn't it? Where we're screening for the bad stuff, not necessarily.
We're not picking stocks, so we screen out the ones we know we don't want, and we hold everything else.
Okay.
So the only areas that we can actually, if you like, be positive in, our New Zealand bond fund, we support community housing. From our business as a whole, we donate 15% of our revenue to charity. I know in Simplicity Living, they're working very hard on reducing their carbon output. So where we can do anything specific, we are. But from the broader perspective, in our main portfolios, our main funds, they screen out the stuff we don't want. We don't necessarily select stuff that we might prefer.
And it's that cost balance, isn't it? Yeah. Just a wee note from Tim. Looks like a Catalina float plane, maybe.
Oh, thank you. And that would make sense. Catalina's the over in Hobsonville, isn't it? Yeah, that makes sense.
A question from Spencer. How has becoming a default provider changed the way you do things?
There's some good questions. It's just really meant So when we were appointed a default provider, there's a whole load of requirements that came with that in terms of communicating with the people who are default, and trying to make an active choice, or at least take some interest in their investments. And so what it's meant is that there's quite a lot of our initiatives to try and contact people and get them interested in the fact that they've got a KiwiSaver fund, and to try and again educate as far as we possibly can, so that people, for example, young people that are brand new into KiwiSaver, a balanced fund is probably not the right thing if they're saving for a 30, 40, 50-year retirement, and therefore to try and educate them that's something they should be thinking about. And the other thing is that the default members, again, because they've either been thrown at us because they were default with somebody else and they've suddenly become Simplicity members, or alternatively, they've never really taken any interest in KiwiSaver. They're quite inquisitive, and they can be quite they can be quite sort of time consuming to deal with, which is great, and the team do very well, but it's just created a bit more noise in the contact area.
I was going to say, and I don't think I introduced myself. Apologies for that. Kia ora, I'm Jenny. I'm the head of communications and education at Simplicity, a bit of a late introduction. But I was just thinking from my perspective, the emphasis on education and supporting members and trying to inform and educate them so they can be a bit more engaged in their investments, make more informed decisions. I think that's had benefits for all members. In terms of some of our now standard communications. So while it has generated a bit more work, particularly for the investor services team that are dealing with the day-to-day stuff, as a business, I think it's made us even more aware. I know it's always been part of our mission, but even more aware of making sure we are making really useful information and timely information available to our members.
And that was a conscious effort from the start, that we didn't want to just be focusing on default members, that it was, if there was something that made sense for somebody that's one of our members that was default, then it should make sense to everybody. Be
member wide, yeah. So I think it's been mostly benefits, hasn't it? Becoming a provider. Okay, the next question is from Peter. Any thoughts on what international shares are going to do for the rest of the year? So where's that bouncy graph going, Andrew?
Again, as I've said before, I mean, we obviously invest as passively as we can in that sort of thing because we don't know. I guess a little bit like we were saying to that earlier question to John, the US share market in particular seems to have got itself quite heated, but it's concentrated in quite a small number of stocks. So yeah, I'd like to think that the central banks have got the finger on the pulse, and that they're going to start reducing official cash rates at the right sort of time, so that if we get any sort of bottoming out, it's as they say, shallow. And so far the signs are that, as I say, the economies are continuing to be quite resilient. So if everything carries on as it's going at the moment, I think the rest of the year will be fine. It's just those, you could just never predict where something like Russia invading Ukraine or Gazans bombing Israel are going to throw spanners in the works. And it's that geopolitical stuff that, to be honest, I don't know anybody else, I find so incredibly unpredictable, that can swing you around. So that would be, again, from our point of view, that's why we just invest a little bit in everything.
That might be a good segue to a question asked by Tim. What actions, if any, are you taking in light of these wars in Ukraine, Gaza, Yemen?
Yeah, none in particular, really. As we've said many times, we don't invest in weapons, and so that's, if you like, the one area of all this that we've taken some form of stance on. But we actually only, our share investments are only in developed markets, so we're not in the emerging markets, which was a decision we took at a very early stage. So we're generally not in a lot of the markets that are affected by these things directly. But we're not taking any particular stance. We certainly don't take any political stance. We just watch nervously, I guess.
Okay. Tim had another question, but it was about being a default provider. So I hope that we have answered that. Another comment on the plane, which is of real Tasman Empire Airways. I think that's what it might have stood for. Yes.
TEAL, right.
Air New
Wonderful.
Zealand. Thank you, Martin. Getting
Yeah,
more
great.
and more intel on the plane. You will never wonder anymore. A question from John. For retirement calculators and intrinsic value methods, 10% is the recommended annual rate of return in today's market. Do you think this figure is too high or low?
Oh, okay. So I'm not sure what rate that is. I mean, so sorry, John, let me think this through. So the FMA came out with guidance for us on what return we would assume after tax and fees on each type of investment, from defensive up to high growth, or aggressive as they call it. And I'm trying to remember the scale. I think it gets up to 7.5 for aggressive, 6.5 for growth, and so on down the scale. So 10 does sound quite high, but it depends again whether that's pre-tax and pre-fees, because again from memory, the growth rate that the FMA allow us to use in assumptions, etc., would probably gross up to close to 10 if it's pre-tax. So yeah, all those things would influence it, but that's
I think there is.
if that's an overall after-tax return, that sounds high.
I was just going to say there is information on the FMA website and sorted.org in terms of what they're basing those assumptions on. So you could possibly interrogate that a little bit more at the source of those projected.
Yeah, so Sorted use the FMA's returns in their calculations for future balances.
So information's publicly available. So what do we say? It's about right if it's inclusive of fees and tax.
It might be if that's before tax. Yeah.
A question from another John. How much does the investment into affordable long-term housing unbalance your diversification model?
Yeah, great question. So I know I haven't frozen. I'm just trying to think through exactly how to answer that. So on a risk return point of view, we're very comfortable that it is accretive to the funds. But I think you've got to remember that we're in this early stage. The investment is currently going to go through quite a heavy development stage for the next 3 years at least. So we've got the company owns some completed properties, with one more very, very imminently to join that, which is still, it's going to be a reasonable amount. I think we'd be up to about $200 million worth of property. But then there are now 3 big projects on the go, one just getting going. And so you've got to look at that investment with two lenses. There's the physical property that's going to be generating a rental income, and then there's the development side, which should generate substantially higher returns. And so over the course of the next, let's say, 3 years, as we work these through, when the next big one's completed, then we'll have quite a big lump of physical property, and there'll be less development. And gradually, over the course of, let's say, the next 10 years, the development element to the returns will decline substantially, and it will be mainly the return on completed properties and the rental income that's coming through. So it's quite a dynamic investment in a property company. And so going back to your question, the return right here and now is quite predictable. For, let's say, the next year or so, is quite predictable. It'll be when these big property developments are completed. If property market has been flat or down, then that's not going to be good for returns, but we're pretty confident that they won't be. And then increasingly the rental income will come through. And we believe that over long term, this investment is going to perform more like a bond than a growth stock. It's just in this initial period, we're going to see more of a growth element to it. So going back to the modelling, we're very comfortable with the reasonably small proportion of each fund that's being invested into rental property, and very comfortable with the return we're likely to get on a fairly steady basis over the course of, let's say, the next, say 3 years. Going forward, what we may end up needing to do is to reduce the amount of the property fund that's in, for example, the growth stocks, and move more of it into the more conservative stocks, because it will be much more, as I say, like a long-term bond than a growth stock. So the modelling of it's quite is quite dynamic. Actually, it's not static at all. But we're very comfortable that, as I say, the investment that we've made, which is, as I say, it's not massive in any of the funds, but is accretive to them over the next 3 to 5 years at least.
Okay. Thank you. A question from Tim: how have you found the change from Vanguard to DWS? Relationally, returns and tax implications.
Yeah, so we need to do now we've almost hit 1 year. We're going to be able to start doing a little bit of work on whether the tax benefit has been as much as we thought it was, because we'll be able to see what Vanguard's funds have done, etc. So from a returns to investors point of view, they're doing exactly what they said they would do. They're tracking their indices extremely closely, and the asset classes are doing very well, mostly. In terms of the difference between the two, I mean, Vanguard were tremendous to deal with. We'd never say anything else, but I must say what is tremendous now is being able to speak directly to the actual portfolio managers. We're getting much more granular feedback on anything we need to know or want to know. And I mean, it's been a fairly interesting 11 months, again, when you think of some of the geopolitical stuff that's been going on. And they're extremely responsive, very, very helpful. And yeah, nothing's too hard. So as I say, it's the difference has really been that we now own thousands and thousands of shares and bonds, whereas we owned 4 funds when we had Vanguard. We had no real look through into what our underlying investments were. And so that's created quite a bit of complexity, but it also means that, as I say, we can get a lot more detail about exactly what investments we've got and how much we've got of everything. We've got more of everything than we had before as well. DWS take a very literal approach to modelling and passive. So we own every share in the market and more bonds than we ever thought existed, which is great for our investors, because again, that diversification has been implemented very well.
So you'd say overall a positive change.
Oh, definitely. I mean, just in terms of, as I say, just getting real information out of people who are actually managing the money is great. And
one part of that question was around tax implications.
Yeah, again, and so I can't be specific on that because we'll be getting the end of year numbers coming out, the audited net statements, etc., very soon. But our impression from how the funds are tracking relative to the index is that they're doing exactly what they say they're going to do, and it's now a question of making sure that the tax side of things comes through the way it's supposed to our investors. So that one's still not 100% known, but will be very soon.
There's a question here which I think might be a clarification question. So it's duplication of asset class if you invest and divvy it between balanced growth and high growth ? So maybe explaining that a bit more.
Yeah, so I haven't got the numbers in front of me, but if for example the high growth fund has got 50% of its investments in the hedged global share fund, the growth fund will have 40 and the balanced fund will have 30, and then they'll all be proportionate to each other. So the high growth fund has got no global bonds and no New Zealand bonds. The growth fund's got 10% roughly of each, a little bit less, and then the balanced fund's got 20% roughly of each. And so if you amalgamate any variation you like of those three, you'll just get a slightly different allocation to each of the different asset classes that we invest in. I hope that's sort of answered the question. It's just that if you go onto the SIPO, which is on our website, or have a look at the fund update that'll come through in a few weeks' time, there's the actual asset allocation of each of the funds, so you can see that the proportion that they've got of each of those different assets.
And as another member mentioned before, that the target asset allocations are all in the product disclosure statements too. Right? So that's all available on the website. Okay, I hope that clarifies that, or that I phrased the question correctly. Another one from Anonymous. There's a lot of innovation in the investing space at the moment. Sharesies KiwiSaver is an example of an offering that is non-core to their main product. Is Simplicity thinking like this, or do you have a more stable, focused, longer-term plan?
I think I've had assurance from Sam we're not launching anything new for a little while. Last year was quite enough, but no, I think we're reasonably comfortable with the way we've got everything set up at the moment. There might be a few tweaks here and there, but fundamentally, we're not looking to, certainly not to go out with sort of new platforms or the like. I think the move from Vanguard was fairly major last year, and has created additional products for us that are beginning to get really good traction. So no, I admire really what the likes of Sharesies are doing. I think it's great to be innovative and to hopefully broaden the appeal of financial products. But I think we're pretty set in our managed investment scheme world.
Yeah, I think any innovation that we'd be focused on would be more around our member experience and kind of the tools and services that we can provide, rather than new products or
Yeah, absolutely.
A lovely comment from John saying, "Thank you, Andrew. Both you and yourself, both Sam and yourself are wise investors." Thank you,
Well,
John.
that's very kind. I'm flattered.
He is quite wise. It's true. Okay, another anonymous question. Why does Simplicity Living have such a high proportion of its funds in cash and fixed interest? This might be related to the Homes and Income Fund rather than Simplicity Living.
Yeah.
I would like an investment that could replace direct investment in residential property, but this is actually only a small part of this fund at the moment.
That's a great question, and it's been really interesting, the feedback from Sam going around the country to promote the Homes and Income Fund. We appreciate 100% what you've said, actually, and I think the response to that will be that we will move the Homes and Income Fund, I hope I'm allowed to say this, to have more of the Simplicity Living shares than it currently does, or is targeting, for that very reason, because I think we should be able to create a very good proxy for owning residential property directly. And the only issue with that is that because it's a retail fund, and therefore we have to be able to provide daily liquidity, if the whole thing was invested in the Simplicity Living shares, there'd be nobody to buy them on the other side, so we couldn't have it 100% in residential property. What we will be trying to work through is what proportion of the fund we could have, what's the maximum proportion we could have in the property fund, while still being able to provide daily liquidity to anybody that comes and goes. So we're working on that. That's a good question, and hopefully that's something we'll be able to advise on, advise everybody over the course of the next few months at most.
So that's an evolving story.
I think we were surprised, really, that I don't know why we were, but we were surprised that so many people were so interested in Simplicity Living, when we thought that that should be part of a more of a mix. But what we realized very quickly is that actually that really the bonds and the cash and the mortgages side of things is nice to have, but actually it's the property side that people are more interested in.
And that's a little bit one of the reasons why Sam has been out on the road talking about the Homes and Income Fund, right? To get sort of feedback directly from members and have these conversations.
Yeah, absolutely.
So he's still on the road. If anyone hasn't seen him yet, we're still sending him out and about as much as possible. The next question is, I would like to invest in Simplicity Living, but I would like the homes to be built to a passive house standard. Could you look into this, please?
Sure. And I know that the principles of Simplicity Living, etc., are very focused on, as I said earlier, on making sure that the way they build and what they build are as environmentally friendly as they possibly can be. So I'll look into that specifically, certainly.
What we build to a Homestar 8 standard at the moment?
Oh, I can't remember. I've got to be very careful with that, because somebody told me that whatever Homestar it was, one entity were advertising they were building to was sort of the basic building code.
Yeah, that's 6.
Right. Yeah. Oh, yeah, you know better than me.
Yep. Yeah, so building a passive house is a very specific way of building, isn't it? But we have direct lines of communication with the Simplicity Living team, so happy to, you know, find out a bit more about that. This question from John starts with not a question. So just a comment. In the US, they have shown strong jobs data and strong economic growth. If interest rates were to drop, we might have a resurgence of inflation, like in the 80s. So interest rates are higher for longer. In New Zealand, we have a stalling economy. And if the Reserve Bank drops rates prematurely, we may have a resurgence or face stagflation. Higher interest rates allow government debt to be repaid at a cheaper rate, and central banks don't typically drop OCR out of the goodness of their hearts, but because something in the system is broken or sentiment no longer warrants high rates.
Yeah, there's a lot of good things there. I mean, one thing which I think one issue for governments is that higher interest rates mean that they're actually having to pay higher interest to investors when they issue bonds, which is the reality for particularly countries like the US at the moment that have got a lot of government debt out there. So I'm not sure about that point, but in New Zealand, as you rightly say, I mean, the economy is not as strong here. One of the issues for the Reserve Bank of New Zealand is that if they were to decide that the economy was in a dire enough strait that they needed to reduce rates, if you like, earlier than elsewhere, it would probably undermine the New Zealand dollar, which then is inflationary. So, yeah, I mean, again, I can't really comment, John, other than to probably agree broadly. And exactly as you say, the reality of the last few weeks in particular has been that there's an acceptance that rates are unlikely to come down anywhere near as quickly as the market had anticipated. And that's why, as I said before, we're going through this sort of slightly strange period where good news can be bad news and bad news isn't necessarily bad news. It's always a bit strange when the market gets to this state, and we'll probably wobble around in this for at least a few weeks, if not a couple of months.
Okay, great. Then I've got 2 from Robin. One is another not a question. I love these webinars. They're very helpful and reassuring. Thank you all. But then they also have a question. Just out of curiosity, do you have any updates on the Homes and Income Fund? Are you happy with the performance and the uptake by customers?
Again, yeah. So broadly, yes, is the first answer. Are we happy with it? One of the problems for the Homes and Income Fund is that it tends to hold a lot of cash for a while because it can't invest, for example, in the property fund when it wants to. It has to wait until the property fund needs money. We would like to be doing more community housing. At the moment, there's a bit going on in the background there, so there haven't been any bonds issued by those entities for a little while now. And similarly with the mortgages that are supposed to be in the Homes and Income Fund or are in the Homes and Income Fund, again, we can only lend out money when people want it. So it's a little bit, the Homes and Income Fund is a little bit more of the assets it invests in need to pull the money out into them rather than it being able to invest straight into them. And so it's a bit disappointing that that quite a lot of the money is sitting in cash. I mean, it's earning a good return, but it's not invested as well as we would like it to be longer term. In terms of the response, probably slightly better than I'd expected, actually. Because from my perception, the type of person that the Homes and Income Fund is going to appeal to is probably going to want to wait and see what the returns are before they're comfortable putting any money in there, rather than sort of effectively being in the early stage. But at the same time, the returns are solid. It's chugging along at sort of 6-7% a year, and I'm sure it will people will be happy with that, provided it has a bit of a boost from the property fund every now and again to give it a bit more. But I mean, the short answer is that we're very happy with the way it's gone so far. The reality is that, as somebody said earlier, there's just too much cash in the fund at the moment.
I'm aware that it's almost 1 o'clock and we do still have a few questions, but there's quite a few comments. I might have to skip over a few of the comments and just hit the last few questions. One is, with the New Zealand market being so small, why have any money invested in it at all? I.e., would it be better in a diversified way to be just global?
Yeah, no, tremendous question. I mean, I suppose every country has their home bias. If we, as you say, if we invested in New Zealand to the proportion it is in the international index, we'd have almost no investments locally at all. There's two elements to it that we feel. One is that we'd like to support the local share market, support the local companies, invest in New Zealand for New Zealand investors, which is that home bias that we have. We're probably a little bit less invested in New Zealand than a few others, but equally there are a few out there that have got most of their investments overseas. So we've taken a little bit of a middle route to the vast majority of the market. We sort of monitor about 12 other providers to see where everybody else is, and we try and strike a median based on that, which is why we've got the ones we have. The other point I'd just quickly make on that too, though, is, and this is actually a globally emerging theme, a lot more people are looking at private equity now than they used to. Particularly, I mean, in New Zealand, private equity, most companies in New Zealand are below listing level, and so there's a wealth of wonderful companies doing really good stuff in New Zealand, but that don't either need or want to list. And so we think our initiative in just looking for those companies that need a little bit of capital but that don't want any involvement is worth carrying on. And it'll be interesting to see if the theme, which I believe is becoming much more of a theme in Australia in particular, continues, because private equity has greater risks, but equally, provided you invest wisely, it does seem to have good characteristics in periods where other markets aren't doing quite so well. So we'll see.
And we do have a small private equity fund. There's a dedicated page to that on our website where you can find out a bit more about the 6 companies, New Zealand companies that we've
directly. There's a lot that we invest in through Icehouse. The 6 that we have invest directly there.
Okay, thank you. Quick question about the charities, about the Simplicity Foundation. Curious to know who and why chooses the charities that you support. Awesome contribution to the communities that are definitely struggling out there.
Well, that's probably more you than me, Jen.
Yeah, I guess so. So I used to work for the foundation. The foundation focuses on 4 pillars, which have been essentially determined by the members. So we did surveys in the early years to work out what the priority areas were. So homelessness and hunger, environment and climate change, youth development and education. And there is a group of trustees on the foundation, and they are the ones that assess applications that come in those key areas and then make funding decisions. Again, on our website, the foundation has a page which goes into a bit more detail about that process. And I mean, to date, we've given over $7.5 million away to New Zealand charities, so it is making a significant contribution, and the trustees do a really, really good job at making sure that that money is going to have a real impact in the communities that these organisations are working in. So hope that answers your question. And I think there's one, oh, there's a, never mind the plane, what about those lovely pictures?
Yeah. So
again, a Sam question.
Yeah, it is a Sam question. There's these are all a series of prints that are actually photos that have been painted by hand. They were all done in the 50s, I think, taken around New Zealand, and I mean they're really interesting, and literally all around. I mean, you recognise most of the places from a long time ago, but yeah, so like it's a nice environment to be in.
It's a beautiful room, the one that you're in. A quick comment by John, who I think asked an earlier question about the retirement calculators. He said 10% is pre-tax.
Right. Yeah, I mean, provided we're talking about sort of growth fund type investment, that is probably in line with what the FMA and so on are using as an assumption.
And I think there is one more question in there from Spencer. Not that I expect Takapuna to slide into the sea anytime soon, but do you have any resilience plans or planning underway given the growth of Simplicity?
Well, we have to have a very detailed what's it called, disaster recovery, DRP. Yeah, that's a really interesting question in terms of we've still got plenty of room for expansion in the building that we're in. We are planning to grow substantially over the course of the next 5-10 years, and we'll keep working on that. But I'm just trying to think of any sort of resilience type comments. I mean, fundamentally, everybody's able to, and most do, work from home regularly, and so I'll always think back to those first few days of the pandemic when a number of companies were scrambling to try and work out how they could work from home, whereas we've been doing it right up until the beginning. So I think from a resilience point of view, we're all reasonably well used to it.
Cool. Well, it's 4 minutes past 1. Thank you very much to the majority of you that have held on right to the end. Apologies that I can't get through these last comments as opposed to questions, but thank you for your feedback. If you do want a sort of a response to any of the comments that you've made and we haven't answered, please do email info@simplicity.kiwi and just say for Andrew or for Jenny, and the team will pass that on to us and we can get back to you. And apologies for the slightly dodgy beginning to this.
I'll get better at it. But I mean, similarly to that, if anybody has any questions, the simplest thing is just if you put them on the info@simplicity.kiwi email, they'll always get through.
We'll get right back to you. So thanks very much, everyone. We're going to try and do these sort of sessions a little bit more regularly than we have been doing, either with Andrew or Sam or someone else in the investment team. So hopefully you can tune in next time as well.
Great.
Thanks very much.
Thanks, everyone.
Bye.